Hello and welcome back to our InvestEd vidcast series. I'm Chris Sabula and I'm here today with Mark Armbruster. We're talking about exuberant and irrational trading and the emotional response that it can elicit in investors. This topic seems particularly timely as Eastman Kodak, a favorite point of discussion in our hometown, made the news recently when it secured a $765 million loan from the federal government to launch a new pharmaceuticals arm. In the span of just a couple days, the stock went from trading around $2 to a high of $60. Pretty crazy, right?
Indeed it is. Unfortunately, the aftermath of that stock rise was a subsequent fall, which leaves the stock currently trading under $7 per share. However, we're not here to pontificate on the decline, but rather to focus on the run-up and what drives investors to act irrationally. It doesn't seem rational to invest in a company whose stock just rose 3,000% on news that they secured a loan that will allow them to do something that's extremely low margin, that they've never really done before, and never mind the fact that they have a long history of failures and even bankruptcy.
This tale is as old as investing. Even the esteemed Sir Isaac Newton, a leader of the scientific revolution and the one who has laws of physics named after him, has fallen prey to investment hype and succumbed to his emotions. The South Sea Company, one of the earliest and most cited investment bubbles, was the stock to buy back in 1720. Newton participated in the run-up and successfully bought and sold shares, doubling his money. After selling, Newton continued tracking the stock price and noted that it just kept rising. He couldn't handle the fear of missing out and subsequently bought more shares at 3 times his original price, only to eventually lose what would have been about $4 million in today's dollars.
The story goes that as a result, Newton commented, "I can calculate the motion of heavenly bodies, but not the madness of men." So what drives investors, even the smartest among us, to do irrational things? Don't we learn from history?
Some of us do, but fear and greed can be powerful forces. There's some interesting data behind the Kodak trading story. The new Robinhood trading app, which is mostly used by younger and less experienced investors, went from having 9,300 accounts holding Kodak stock to over 130,000 during the 2-day run-up.
Right, and most of them have lost money on their trades at this point.
It seems that these wild stock swings are being magnified by real-time access to social media, hype, and news rather than investment fundamentals and common sense.
Obviously, there are no guaranteed ways to predict the future, but following some common sense rules seems in order. This type of investing, this Robinhood type of investing, is more akin to video games or online poker than prudent long-term investing. And while it may be fun, it seems unlikely to be profitable for most participants over time.
Even for the more impetuous among us, there are simple steps that could help improve the odds of success. A quick trip to any of the free finance sites like Yahoo, CNBC, or Google would have given you some valuable info about Kodak. First off, the company has negative earnings per share, meaning they lose money. As a result, there's no PE or price-to-earnings multiple, making it much harder to come up with a rational valuation for the shares. That alone should be a red flag. Kodak is a widely known company, yet it had a minuscule market cap of only around $200 million before the run-up. Also a red flag. And a quick peek at the stock's 52-week range with a low of $1.50 should also trigger some alarms when you're looking to buy at $60 per share.
Also, there are literally 0 analysts covering the stock, not one.
While none of these are necessarily reasons to avoid a stock, they should give you pause when considering whether to buy and what valuation is reasonable. Another thing to consider while taking your pause is to take a peek at the company's competitors. What are they doing? What do their stats look like?
Right, Fujifilm is already leveraging its specialty chemical manufacturing expertise in the pharmaceutical industry. And that makes it a good comp for Kodak. Fuji has had steady earnings, a relatively stable stock price history, and strong management, none of which are true for Kodak.
Again, this doesn't mean that Fuji is necessarily a better buy than Kodak. It's just a way to reset your thought process and make sure you're not getting caught up in the hype. Also, are you buying a damaged stock or a damaged company? There's a big difference. A damaged company like Kodak could result in big losses. A damaged stock may be a buying opportunity.
That's true, but investors should take it even a step further and consider their objectives. If you're really investing for the long term, then have a focus on the long term. A strategy that includes looking for opportunities to diversify your money across various markets and holding hundreds, if not thousands, of stocks through cost-efficient vehicles like ETFs are more important than chasing fads and trying to get in front of the latest hot stock. And perhaps most importantly, try not to let emotion get the best of you. Taking action because you're afraid of missing out or have fears of impending doom will do far more damage to your long-term investment returns than anything else.
In summary, in today's ultra-connected investment environment, it's tempting for investors to let emotions get the better of them. Everyone wants to make a quick buck and to be able to tell their friends about a successful trade they made. Particularly with the stock market at lofty levels, jumping on the bandwagon will result in disappointment more often than not. While it may seem rational to get in on the gravy train, there are just too many pitfalls. Taking the emotion, and really the fun, out of investing by focusing on a diversified, balanced portfolio is really the only reliable way to build wealth, even if you're as smart as Sir Isaac Newton. As always, please give us a call if you'd like to talk in more detail about this or any other investment-related topic. Thank you for joining us today, and we look forward to having you tune in to future ACM InvestEd vidcasts.